Warren Buffett is a name synonymous with investing. He is known for his wisdom and long-term approach. Investors around the world pay close attention to his moves. So, when Buffett makes a significant shift in his investment strategy, it sends ripples through the financial world. Recently, Buffett made headlines by reducing his exposure to U.S. stocks. This unexpected move has left many wondering about the reasons behind it. Buffett, often called the Oracle of Omaha, has built his reputation on identifying undervalued assets and holding them for the long term. His company, Berkshire Hathaway, holds a massive and diversified portfolio. This portfolio includes everything from consumer goods companies to energy giants. A significant portion of this portfolio has historically been invested in American companies. This makes his recent move away from U.S. stocks all the more noteworthy. This shift in strategy signals a potential change in Buffett's outlook on the American economy. While he hasn't explicitly stated his reasons, speculation abounds about what might have prompted this move. Some analysts point to potential concerns about U.S. market valuations. Others believe it reflects a broader global strategy. Whatever the reasons, Buffett's decision has sparked a debate about the future of the U.S. market and the global economy. Investors are carefully watching his next steps, eager to see what the Oracle of Omaha does next. While reducing his stake in U.S. stocks, Buffett has simultaneously increased his investments in another market, Japan. This move further underscores his changing outlook and his search for value in different parts of the world. Specifically, Buffett has increased Berkshire Hathaway's stake in 5 major Japanese trading companies, known as Sogo Shosha. These companies are conglomerates with diverse business interests, ranging from energy and commodities to food and textiles. They operate globally and offer exposure to a wide range of sectors. Buffett's interest in these companies is likely driven by their attractive valuations and their potential for long-term growth. Japan's economy, while facing its own set of challenges, offers a stable and established market for these trading giants to operate in. This strategic allocation of capital to Japanese markets suggests that Buffett sees greater potential for returns there compared to the current U.S. market. It also highlights his willingness to adapt his strategy based on changing global economic landscapes. By diversifying geographically, Buffett is positioning Berkshire Hathaway to weather potential storms in any single market. This move is a reminder to investors that opportunities exist beyond their home countries. It underscores the importance of a global perspective when making investment decisions. Buffett's recent moves haven't come entirely out of the blue. He has a history of expressing concerns about economic policies and their potential impact on markets. In past letters to Berkshire Hathaway shareholders and public statements, he has cautioned against excessive government spending and the dangers of inflation. While he avoids making direct political commentary, his warnings about fiscal folly have resonated with investors over the years. Some speculate that his recent decision to reduce his U.S. stock exposure could be linked to these long-held concerns. The U.S. government's increasing debt levels and the potential for inflationary pressures might be making Buffett wary of the long-term health of the American economy. He might be anticipating a period of economic uncertainty, prompting him to seek safer havens for his capital. Buffett's approach is often described as value investing. This means he seeks out companies and assets that are undervalued by the market. He believes in the power of patience and long-term growth. His recent moves suggest that he might be struggling to find value in the current U.S. market, given its high valuations and the potential economic headwinds. His decision serves as a reminder to investors that market conditions can change and that it's essential to adapt strategies accordingly. It also underscores the importance of considering macroeconomic factors when making investment decisions. Buffett's influence on the investment world is undeniable. His actions often influence other investors, big and small. When he makes a move, it's natural for others to wonder if they should follow suit. His recent reduction in U.S. stocks and increased investment in Japan have undoubtedly caused many investors to reevaluate their own portfolios. Some investors might interpret Buffett's moves as a sign of an impending market correction in the U.S. They might be tempted to follow his lead and reduce their own exposure to U.S. stocks. Others might see his investment in Japan as a signal to explore opportunities in overseas markets. However, it's crucial to remember that every investor has different goals, risk tolerance, and investment timelines. What makes sense for Warren Buffett might not necessarily make sense for everyone else. Blindly following the moves of any investor, even one as successful as Buffett, can be risky. It's essential to conduct thorough research, consider personal financial circumstances, and consult with financial advisors before making any major investment decisions. Buffett's moves serve as a valuable reminder to stay informed, be adaptable, and always think long-term when it comes to investing. The Oracle of Omaha might be adjusting his sails, and that means it's time for every investor to check their own compass and chart their course accordingly.